So, you've got a 401k. Congratulations! You're a money manager. If that makes you feel a little uncomfortable, then stick around. In this video, we're going to look at what are some of the likely investment options in your 401k and which of those might be right for you. Stay tuned. Managing your 401k coming up. Hey everyone, it's Jeff Drayton, Certified Financial Planner Professional and founder of Jeffrey A. Drayton Financial Planning and Wealth Management, LLC. In this video and others, I share my thoughts on financial planning topics for individuals and households. If you're watching this on YouTube, don't forget to hit that subscribe button, and if you're viewing this from the vlog page of my website, please take a minute and fill out that sign-up form so that we can contact you when new content becomes available. Today I'm talking about the investment options in your 401k. You know, 94% of employers in this country offer a 401k retirement plan. This wasn't always the case. As a matter of fact, the 401k didn't really come into use until around the early 1980s, and then mostly as a result of a benefits consultant by the name of Ted Benna. Before then, if an employer offered a retirement plan, it was most likely a defined benefit plan, which is to say, a pension. Pensions have a number of differences from contribution plans such as a 401k, and a big one is this. In a pension plan, the responsibility for overseeing, managing, and investing the assets in the plan is on the employer, not the individual employee. 401ks change that. With a 401k, now you have the responsibility of managing your assets. You see, 401k contributions are in an account that is exclusively for you. It has your name on it. Whether the contributions were made by you, your employer, or likely a combination of both, you are the one who will need to oversee and manage the assets in that account. This was a big change. Now you have a number of decisions to make when participating in your employer's 401k plan. First, you need to decide how much you will contribute. This is your savings percentage. Also, your employer might offer a Roth option in your 401k, which refers to how you want your retirement assets to be taxed, either up front or down the road. These are important considerations, but in this video, I'm going to talk about your investment options, where you want your investment dollars to go. So in adopting a 401k, your employer shifted much of the management responsibility of the investment assets to you, the employee. However, they still have a responsibility for the investments available in the plan, and that responsibility requires them to offer a broad range of investment alternatives. So what constitutes a broad range? Believe it or not, they need to offer at least 3. And even though the vast majority of plans offer more than that, it's good to know what a 3-option 401k might look like, because even if your plan offers 50 fund choices, those several funds still need to reflect the distinct asset class alternatives that could have been provided with far fewer options. So what would a 3-fund 401k likely have? Well, it will probably have an equity or stock fund, a bond fund, and it would also most likely offer a cash option, such as a money market fund. It will have these 3 possibilities because different asset classes are more appropriate for particular employees depending upon where they are in their career cycle. As an example, if you are an employee who is at or near retirement, you will want some portion of your retirement assets out of the market, which is to say, out of stocks, and into either fixed income or cash. This is certainly true for those assets that you plan to be living on in the near future, say anywhere from 1 to 3 years. You see, any assets that you are going to need on that short of a time horizon would likely not have time to recover if and when a market downturn occurs. Holding those assets in cash ensures that they will still have their value in the near future when you anticipate needing them. However, cash is not an appropriate option to make up a large percentage of the portfolio for a younger employee, say someone who is still decades away from retirement. A money market fund will pay an interest rate that will very likely not exceed or even meet the rate of inflation. Over a long period of time, those assets would probably lose value. Certainly not the goal of someone who is trying to accumulate their retirement nest egg. In this situation, a person is likely seeking growth, and growth at a level that probably can only be achieved when one is willing to be exposed to a certain amount of market volatility. This would occur in an equity fund, which is to say, stocks. However, the volatility of stocks will hopefully be mitigated by the fact that over a long time horizon, many years or decades, those market ups and downs should have sufficient time to even themselves out, hopefully with an overall positive trajectory. So, it's time to pick your funds. Where do you start? Well, first, you need to assess your personal situation. What are you trying to accomplish? Are you looking for growth? Or are you simply trying to maintain what you have and not put all of your years of successful saving in jeopardy? Next, decide on the mix of asset classes, stocks, fixed income, or cash that you feel will get you there. As an example, if your retirement is a long way off and you are looking to achieve aggressive growth, you might invest in a portfolio that is entirely or close to it in stock. However, again, if your goal is to not lose what you have, then you want principal protection. This is achieved by keeping that portion of your portfolio out of the market and in cash. Most people are somewhere in between, willing to take on some risk, but not willing to watch their entire portfolio ride the constant ups and downs of the overall market and the business cycle. An example of a portfolio for this type of investor might look something like 60% in an equity fund, 30 to 35% in fixed income, which could be, say, an investment-grade bond fund, and the last 5 to 10% in cash. Lastly, you will now want to pick the fund or funds that gives you that mix of asset classes that matches what you have set as your target portfolio. This can be done by either looking at each fund's prospectus or possibly by getting a summary from a research company such as Morningstar or the like and finding out exactly what assets each fund holds. Once you've identified the fund or funds that will give you the right mix of assets to match your target portfolio, you are now ready to make your allocations. Now I know there are many of you who will find the process that I just outlined a bit daunting. What are some of your options when this is the case? Well, let me list a few. First, you will very possibly have among the funds available in your 401k a fund type called an asset allocation fund. Funds such as this really seek to be all things to all people, or I should say, all things to all people who desire the type of asset allocation that the particular asset allocation fund is seeking to achieve. These funds often have names such as the Moderately Aggressive Asset Allocation Fund. In that case, the name tells you quite a lot. It is telling you that this fund seeks to have a portfolio, probably some mix of stocks, bonds, or cash, that represents what the fund manager or managers believe will achieve moderately aggressive growth. You'll still want to do your due diligence, get a prospectus, or look for a summary of the fund online to ensure that the fund's asset allocation and investment goals are in line with your own. But a fund such as this will have a professional manager or team of managers making the actual investment decisions for you. A second option is a fund type called a target date fund. Something you have already learned is that the types of assets that you should have in your investment portfolio is partially dependent on where you are in your career cycle, meaning when are you going to need this money? Therefore, your portfolio should be assessed periodically and reallocated to reflect the different points that you are at in your career. Many people do not do this. Therefore, a solution that was created by a number of investment companies was this type of fund. They typically have names such as the 2035 Target Date Fund. Here again, the name tells you a lot. This would be a fund that will make changes to the fund's portfolio, moving from possibly a growth allocation to a portfolio that seeks to protect the investor's principal and doing so on a schedule that will achieve that conservative portfolio by the target date of the fund. Again, you should do your due diligence. The exact plan and schedule for making these changes to the fund's allocation should be spelled out in the fund's prospectus. Lastly, another option would be to get some professional help. To do this, I recommend that you seek help from a certified financial planner professional. This is indicated by the letters CFP with the registered trademark sign following his or her name. One thing that is certainly true about the previous options is this. Either an asset allocation fund or a target date fund will be what one might think of as an off-the-rack solution. These are not tailored fits. This is not to be critical of these options, either might have its place. It's simply an acknowledgement that those managing whatever mutual fund don't know you. A certified financial planner professional should be able to assess all of your 401k plan's investment options. He or she can take into consideration your exact situation, your goals, your time horizon, and your tolerance for risk. Furthermore, this professional can also take into consideration any other investments that you have. This includes those that are outside of your current 401k, and then incorporate those assets into an overall investment strategy. Thanks for watching, everybody. Once again, I'm Jeff Drayton. Hey everyone, as always, nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner, someone who knows you and your situation. I would encourage you to seek out someone who is a certified financial planner. This is signified by the letters CFP with the registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. Now that's two words, fee-only, not fee-based, not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.